All right, good morning. Welcome to Finance Friday. I'm your host, Todd Ridke, co-chair of the Finance Committee, also serving as vice president of the board. This meeting is being live streamed, recorded, and will be available for the next several months on the website. I'll do a few introductions. Today we're joined in the studio by Ms. Juanita Kerber, one of the new board members who started last month. We were excited to have her join us. She was excited for the assignment to this committee, and thank you for coming. We look forward to your insights. We're also joined by Anna Shurak, who's not new to the board, but I think new to this committee. Thank you for joining. The other co-chair of this committee, Sarah Thomas, is not with us this morning, but we're fortunate that Dr. Soudner, the board chair, was able to come. So we have a full, we're over quorum. We have a full slate of board members for the meeting. On the administrative side, we have Mr. Victor Orlando, who's the Chief Finance and Budget Officer for the district, who will be running the meetings for this series. All right. What is the point of the finance meeting and why are we here? This district runs on money. Turns out, quite a bit of it. And the goal of the point of this committee is to provide meaningful governance and oversight throughout the budgeting process. So we are starting now this winter to prepare the budget for the 2026-27 year. We are currently operating on the budget that we approved a year ago through a similar process. So as we've done in prior years, we're going to start today with the state-mandated independent auditor's report. Carl Hogan is here today to do that. He'll be introduced by Mr. Orlando shortly. But the point of that is to understand where we ended the year on June 30th. We'll look at the total revenues that came in. We'll look at the total expenses. We'll look at the debt burden, and we'll compare it to prior years. So that sets a framework and can inform the budgeting process for this year going forward. After that, we have a series of meetings, one a month through May. We'll initially go through next month all of the revenues. After that, we'll have 2 sessions devoted to the expenditures, the instructional expenditures, the non-instructional expenditures. And then in May, we'll put together the final budget, which will be presented to the full board for approval, and then presentation to the state in June. All right. So I think with that, we'll go ahead and get going with... Yeah, so what we're going to do today, we're going to follow a structure that's parallel to what we're instituting for other committees. We're going to get through the presentations, and we'll have board questions. We'll then entertain any questions related to the agenda topic today, which is the audit, from community members, first in person, and if anyone's online, we'll take those questions too. After that, if there are any additional questions, they have to be finance related or comments, we can entertain those, although it is likely that those types of questions would be more appropriate for some of the following sessions. If you have a revenue question, an expenditure question, it would probably be best to put those off until we get to those topics later in the season. All right, but with that, Mr. Orlando, good morning.
Sure. Good morning. Thank you, Mr. Ritke. So today, as was stated, all school districts required to have an independent CPA firm to audit the financial statements and the financial activities of each school district. Today, we have Carl Hogan, who's a partner with Clifton Larson and Allen, which is a CPA firm that did this particular year ending June 30, 2025 audit report. So I'll turn it over to Carl, who will give an overview of the audit report, highlighting different things. Obviously, the report's 90 pages, so we're not going to go through all 90 pages, but we'll highlight those areas we believe that are what the public would want to look at. So I'll turn it over to Carl. Thank you, Carl.
Yeah, just so everyone knows, the full 91 pages is connected on board docs to the agenda for today's meeting. It is in a draft form that will be certified over the next month, and we anticipate that next month we'll have the full thing, which will then go front-facing on its own web page, district web page, and along with the past 10 years of
Correct. So the final audit report is scheduled for next next month at the February board to be accepted by the board, which is a requirement.
That being said, I know the report's a little bit hot off the presses, so I know everybody didn't get a chance to review, 90 pages of the audit report. So I really encouraged everybody to review the whole draft and any kind of questions relating to Vic. And then, I'll be available for any kind of questions. I'm sure Vic will be able to answer any questions that you may have, because the bottom line is these numbers should look very familiar with what was reported to you by this by the business office, so there's no surprises here. But just to reiterate, this is a really important baseline. 24-25, where did you end up? You could do your best estimates for 25-26, but this will be your baseline for the 26-27 budget year. So the first couple pages, I just picked out a couple pages which I think are most important as you go into the 26-27 budget year. But the reason why you are hiring us as your independent auditors, as mandated by the state, is to give an opinion on your financial statements for the year ended June 30th, 2025. And as you can see up at the top, it's the first paragraph basically stating that the numbers that were presented to us by management for the year ended June 30th, 2025 were fairly presented. Once again, we don't have any adjustments to your books. There wasn't a situation where we felt, we were looking at the numbers, we were auditing the numbers, we didn't have any adjustments. So like I said before, what you saw in your monthly reporting through July, August for year ended June 30th, 2025 are being reflected here today as we go through the audit report. On the next page of the audit report, the first page, it goes over the management's responsibilities, our responsibilities. This is boilerplate, standard, unmodified opinion language, and there was no modifications to this language. So I'm going to go past that, but I am going to spend some time on the next page here on page number 3. I'd like to point out the required supplementary information up at the top. This is information that we do not give an opinion on within the 90 pages, but I think it's some of the most important pieces of information within the audit report, and I encourage everybody to look at them, especially the management's discussion and analysis, which is the first part of the audit report. It gives management the ability to talk about what happened for 2024, 2025, but since the audit by nature is a historical document, it also gives them the ability to talk about what's happened through the issuance of the audit report and what's expected to happen into the future. So I think it's a really important piece, especially for those people that are advanced users of the financial statements. It's a really lengthy document, and I encourage everybody to at least read the management's discussion and analysis. Also, which is in part, there's a part of the audit report in the back, which is the budget to actual schedule. And I encourage everybody to, it's put in the back of the audit report, but I think it's one of the most important pieces of the audit report, because it's like a report card. You put out your budget, it's the most important thing the board does on an annual basis, and then you kind of see how you ended up. When you do look at that in the back, and I'll kind of touch base on that when we talk about the results for the year, but I think between the management's discussion analysis and the budget to actual schedule in the back, I think they're very important in relation to not only the public, but also the board members. The reason why the budget to actual schedule is put in the back of the audit report, I just want to make sure everybody's aware, we don't audit the budget of the school district. We're actually just auditing the actual numbers, and then it's just a required part of the financial statements to show that in relation to the budgeted numbers. And then also at the bottom down there, there's information that we audit, referred to as supplementary information. There's some combining schedules, a schedule of federal awards, and I'll touch base on that as we go through the presentation. And then the last page of the audit report keeps on getting longer and longer. As they add more and more language. We'll be adding in the report date here within the next couple weeks as we finish up our final documentation, but also this is the final paragraph indicates we conducted our audit in accordance with government auditing standards, which require us to not only look at, perform substantive procedures, but also to perform procedures over the internal controls and the effectiveness of those internal controls at the school district. So the first slide I put here together is the results for the year, basically your revenues, your expenditures, and in this case here, your excess of your revenues over your expenditures, and then also in governmental accounting, we have your other financing sources uses. So as you can see here, you have 4 major funds within the school district: your general fund, Your capital projects fund would consist of bond issuance monies, your capital reserve fund, which are monies that are transfers over from the general fund that were appropriated either through excess revenues over expenditures or through the budget process. And then also you have your debt service fund, which were monies that were put aside to meet future debt service obligations. So we'll go ahead and kind of go over the general fund first. Total revenues, $326 million. In relation to budget, that $326 million was about right on budget, but I do want to stress, when you do look at the budget, this actual schedule in the back, and I'm seeing this school districts across the state, that velocity of revenues, those one-time revenues that we've seen in previous years that have been better than anticipated, whether they're investment revenues, realty transfer taxes, et cetera, they're slowing down. So even though your expenditures continue to increase, school districts were able to enjoy increases in their revenues in relation to those one-time revenues, such as realty transfer taxes, as you can see on the right-hand side there, 5.2 versus 4.9. Earnings from investments, you can see that's also decreasing, even though it's across all the funds, 8.1 to 7.1. So I just want to point that out. In addition, recently you've received some bumps in your state appropriations. I wouldn't anticipate to see those types of increases moving forward during the state budgeting process. But that being said, your expenditures just by nature are going to continue to increase based upon your contractual obligations that you have with different bargaining units. So you kind of have to look at your total revenues and the way you're going to get your total revenues to meet those increases in expenditures, unfortunately through real estate taxes and future millage increases. Other financing sources uses, these are not related to your operations. In the case of the district here, they make an annual appropriation over to the capital reserve fund. The district has a lot of buildings, there's a lot of needs. The district has always been very prudent in terms of making an allocation over to the capital reserve fund on an annual basis. Sometimes it's more, sometimes it's less based upon your operations. In the current year, it was a little bit less than you originally anticipated. I think originally it was like $5 million in the budget. We moved it over $4 million, but in previous years, there were instances where you were able to move over more. But this is a great situation for the school district in terms of there's renovations, there's repairs, there's maintenance. So in the past couple of years, you've been able to fund some roofing projects through your capital reserve fund without having to necessarily go out and borrow additional monies through general obligation debt. So when you take that into account with the excess revenues over the expenditures for the current year, $1.2 million, $4 million appropriation over the capital reserve fund, your net change in your fund balance, a planned change in net fund balance, $2.8 million decrease. So your $27 million at the beginning of the year reduces your general fund balance down to $24.2 million. And that was planned during the 24-25 budget process. The capital projects fund, you continue to have some bond issuance monies that you continue to spend down for various projects. But the biggest project during the current year was a roofing project over at the Gladwin Elementary School, and that was financed through the capital reserve fund. The debt service fund, these have been monies typically. I don't remember in the most recent future any monies being allocated over here. You have the investment income, but when this is what it was used this is what it is intended use for the debt service fund for 24-25. Imagine you went through the budget process. You needed money within the debt during the budget process. You allocated a piece of your debt service budget for 2024, 2025 within the debt service fund. So the debt service fund is used to smooth out your budget. So if you need additional monies that you can't get from the general fund during the current year, you could use that money over in the debt service fund to kind of smooth out your debt service, in this case, your debt service payments for 24-25. So is there any questions, concerns in terms of?
Yeah, how does money get into the debt service fund? I understand how it comes out.
It would be the similar process where you, at the end of the year, if you had excess revenues over expenditures in the general fund, either move it to the capital reserve or the debt service fund. I don't remember anything going to the debt service fund recently.
So the debt service fund, we, several years ago, did some refinancing of some old bonds we were able to save. So for example, if we were investing something at borrowing at 4%, we were able to refinance it at say 2%, Well, that savings went into the debt service fund. So that we haven't done any recently just because the market conditions haven't been, I guess, receptive to that. But hopefully in the future, but that's where it's been. And our plan is, as Carl's mentioned, over the next few years, basically to spend that fund down.
So as we're going into the budget process, to move it over to the debt services or to move it to capital projects, how much of that should be done in the front of the year or can be done in the front of the year? Like planning for it.
And rephrase the question,
So one of the questions that we've had in the past and has, gotten us into a lot of dialogues is having a surplus at the end of the year and then moving it into areas instead of earmarking, saying like, oh, we think it's going to be the surplus and we're moving it into this area. Do we do any of that debt services in the beginning of the plan, like this time of year as we plan the budget? Or does it typically wait to?
No, so it's done at the beginning of the budget.
Great.
So right now I'm preparing the 26, 27, that's incorporated at
Perfect.
the beginning, yes.
Thank you. It was just reaffirmation of the way we're doing it to confirm.
That's correct, yes.
Thank you. It's not like you wait at the end and then you see what you got left over, like
No,
we do in some
no.
nonprofits.
Correct.
Okay.
No, that being said, during the budget process for 24, 25, you thought you were going to be able to move over $5 million, correct? Yes.
In the capital
To the
transfers,
cap-
we do that at the end of the year to kind of see like where we
Yeah,
project,
yeah.
where we're going to be at, make sure we have the funds, to make
Yeah.
sure we don't deplete the fund balance
Yeah.
too much. Because that's one thing you have to be very careful of. There have been some districts recently have been drawing down their fund balance, and they've been downgraded from Moody's on their bonds raised because they've been doing that. And there's been a couple locally recently that have had that happen. We're trying to avoid that, obviously, under our current circumstances, a little bit difficult, but we're working on that for the future.
So, and I'm sorry, I'm piling on the questions because they're all connected to it. So to your point, and then back to your point, one is we're stating clearly and transparently, this is the amount we expect to, or hope to move over.
Yes, and sometimes it's more, sometimes it's less.
Exactly, because that's the way
Yeah.
our society is balancing around funding today. But to state it clearly and transparently at the beginning of the year so the taxpayers know that's a part of the process. So thank you for clarifying that. That's helpful. Again, sometimes it's just to make sure everybody who's listening knows how we do it to ensure transparency of the budget. But to your point around the fund balance, that was one of my questions. And since you brought it up, I'm going to ask it now. Sorry, Todd. Knowing that it's decreasing like that, is it where it should be? Are you concerned about the level it is? And explain a little bit about how it does affect our bonds and other pieces. Like, this is my yearly question.
That's a lot of questions. There's no guideline as to, and Carl, you can chime in, that you have to be at a certain level accounting-wise. Moody's looks at different levels to get different higher ratings. They require substantially more than this. I don't have there's a whole formula they have and chart. So to their standpoint, they would probably frown upon, a $330 million budget, and you only have like $24 million, which is what, 7%. So they would probably frown upon that. Right now, I think we're okay at where we're at. Again, in the current budget process too. I mean, we still, due to the litigation settlement, are going to have another decrease. To what level yet? I don't know. We plan on $3.5 million. So if that's the case, you're going to be down 20. You're going to be down to like 20 million. So now you're going to be at between 5 and 6%, which is kind of low. So considering we don't have a lot of other funds set aside in the other funds, our capital project fund is pretty much dwindling because we spent most of that. Our capital reserve, most of that has already been earmarked, for that. And the debt service fund, our plan from several years ago was to eventually, over the next few years, basically spend that money. Now the question be, could the markets be better for us for borrowing? That maybe we can refinance, maybe we can save some money. I don't know. Right now it doesn't look like it, but so that's kind of where we're at. So. Yeah, it's getting a little bit alarming as it keeps dwindling down. Other districts that are much smaller than us have much more money than we do in their fund balance. So, but it's it's something we need to look at. But it's getting tougher and tougher just with the way The index is, as Carl mentioned, interest rates are declining. So we were getting well over 4% last year. Now they're at 3.5%, and most likely are going to continue to drop as they keep cutting the rate. Who knows what's going to happen when there's going to be a new Fed chair, probably in the spring. So that's going to impact us. I mean, transfer taxes came down, slightly, but we're still seeing, pretty level as far as houses are selling, things that we are, though, experiencing still a reduction in the assessed value. So a lot of commercial properties still are, between July when we started and the end of December, 6 months, it probably went down, I forget, like close to $30 million. That's a lot.
A lot of this is going to be revisited in
Or
more
is that,
detail
yeah, all like in the next time,
meetings
so I
going
won't
forward when we
belabor
get
it,
into,
but, yeah.
the revenues.
Yeah.
So I think I'd like to try to keep this focused on the audit,
it's-
and we're getting a little
Yeah.
sideways.
Yeah.
We're going to get into this in the
Great.
next month.
It's
okay?
helpful, and thank you for doing that, Vic, and thank you for indulging me, Todd, on this. But part of it is to just making sure people hear all these pieces at every single meeting. What are these other areas of the budget that we have to keep an eye on, and how do they affect the district's standing? And I will say that the chamber just had a huge event on the economy, and they were cautiously optimistic in Pennsylvania. So I don't know if I feel the same way, but it felt good that somebody was saying that.
Yeah, so, I mean, just to piggyback off what Vic said, yes, the district is in a nice financial position currently, but like I said, the size of your budget, given your total fund balance, and PDE does allow you to have up to 8% of your fund balance as unassigned, and we'll look at that on the next page. But it is a balancing act between the needs of the school district, public perception, et cetera. So, $24 million may seem a lot to the public, but when you're dealing with almost a $350 million budget, things could go sideways pretty quick. And I've seen that happen before too, so. All right, next slide. So we kind of went over the ins and the outs, the revenues, the expenditures. And this is, as of a point in time, as of June 30th, 2025, what your assets are, your current asset, basically your current assets, current liabilities, and the excess of those assets over your liabilities being the fund balance that we just spoke about. As you can see up at the top, most of the district's assets are in liquid cash at year end. District is very limited in what it can invest its money in. There are certain instances they can invest in certificates of deposit, U.S. Treasury bills, and other kind of short-term liquid investments. But for the most part, most of your cash is invested within liquid external investment pools, either through Pliger or PISDLAF. Also, you will see your other largest asset at year end is due from other governments. This is basically amounts due from PDE. You incur expenses. PDE primarily reimburses you for a portion of those expenses, whether they be for federal awards. But a big piece of that is in relation to the 50% of the PSERs that they reimburse you on an annual basis. As you come down, liabilities, you have your accounts payable, and that's remained consistent year over year. You receive a certain amount of invoices, especially as it relates to, tuition, et cetera, that comes in that is relation to June 30th, 2025. We want to capture those expenses in the right year. But by far your largest liability, current liability as of June 30th, 2025, is the amount that is due for salaries and benefits that are incurred through June 30th, 2025 and not paid until after year end. So teachers work September to June, they earn salaries, benefits, and they get paid out through August for those services that they provide. The other big piece there too as well is PSERS is paid in 4 quarters. The 4th quarter is not due till September 2025, so that's a big portion of the amount that's accrued that was incurred prior to June 30th, 2025, but not paid until after year end, and that's just a cyclical thing that happens. Fund balance, as you can see here, so your fund balance is made up into different categories. Non-spendable, just by definition, prepaid items, inventories. You don't have any inventories in relation to your financial statements, but prepaid items are not considered spendable. Restricted amount, anything that's in some of those separate funds, the capital reserve fund and the capital projects fund are restricted by either the bond covenants or the state law that governs capital reserve funds. And then the debt service fund is restricted for future debt service payments. The other restricted piece within your general fund is the final $4 million that was credited to your taxpayers in relation to the litigation, so that's going to kind of fall off. But then we also have amounts that were committed. There was a time and period that your unassigned fund balance was above the 8% as permitted by PDE, and at that point in time, you had committed fund balance for future PSERS obligations as the rates were increasing, which have now kind of stabilized, and then also for future OPEB payments that kind of equates to that liability that the district has for future other post-employment benefits through its single employer plan. So at this point in time, your unassigned fund balance is $6.2 million. I think it's about 5 or 6% possibly of the, or no, it's, what is it? Oh, it's 1 point. Yeah, what I'm talking about, so it's it's about 1 point something, 1.6, yeah, 7.6 of your total, of your next year's expenditure budget. So if I'm looking at that number and I'm looking at it in relation to other school districts in the area or just in the 4 counties here, that's on the low side. So, it might be a future conversation for this committee, other board members. Let's look at our committed fund balance, et cetera. Do we want to move that? Do we want to commit it for other reasons? But that being said, your unassigned fund balance is on the lower side in comparison to other school districts.
Okay, just ask a quick question. The other districts that you see, what's the average that they
A
have?
lot of them are butting up against the 8%.
8%.
And then they're forced. So you're not allowed to have more than 8% of unassigned fund balance, so that's forcing them to move committed fund balance. So, if you take, even if you took all your committed fund balance and you put it in unassigned, you'd still be under the 8%, so.
Okay, but they're closer to 8 in general.
In general, that is correct, especially
Thank
in
you.
this area,
Thank you.
so. And then, there's a 24.2, what it's made up now, and then, just for future thought in terms of, how you want to handle your fund balance and future categorization. Any questions, concerns?
And then typically, at one of the final finance meetings, we go through the fund balances and the transfers, and we'll delineate. Part of the reason we have a lot of expenditures, so it's very easy to assign our
Yes.
funds to things. We have no shortage of places to spend our money, so we'll explain all that. I think it's in the last
the May meeting, correct.
meeting of the series.
All right, so the next page I have here is this, the other fund that we do out of here is you have a food service fund. It's supposed to operate.
Which page is this, Carl? Just so we
Is
can all-
page 25 of the audit
Thank you.
report. Yep, sorry. So page 25, it's the, food service fund. We also audited it as well. In relation, the district has always, operated pretty well in relation to its food service fund. The only thing that makes the food service fund and the results of operations for the year to be funky is that the proprietary funds are accounted for on a different basis of accounting than the other major funds that we just went over. It's supposed to operate more like a business. And since the school district has an in-house food service program, we need to allocate, and they do receive the same benefits as the rest of the employees do. They get PSERS. There is a long-term liability that needs to be recorded on its books, and depending on the liability for the school district is a sizable liability. The total liability is like $350 million, of which $3 million is allocated to the food service fund. And in relation to here, the salaries for the food service fund for contractual increases increased. Even it's only $300,000, but in relation to that $350 million liability, we had to allocate a bigger portion to the food service fund for June 30th, 2025. Hence, the employee benefits increased by almost $400,000. So it's a non-cash item, making the change in net position for the current year to be a negative. In the previous year, in 2024, that allocation was more of a positive, but just because of the increase in the salaries for the current year, even though the total net pension liability did decrease when you do look at it in the audit report, just the larger allocation to the food service fund made it appear that the food service fund operated at a deficit position, but in reality, on a cash basis, it did not. And we'll kind of look at that on the next page. So the next page is just the balance sheet. What you need to focus on as a board and looking at and managing the food service fund is just the current assets over to the current liabilities at year end. I would have, the non-current liabilities piece down there, there's that proportionate share pension liability for PESers. That's what's causing the deficit situation and the larger piece that was allocated over in the current year. But when I'm looking at the food service fund, I'm just looking over total current assets and total current liabilities. And everything is, very liquid, has a positive net position when you look at it from a current asset over current liability position. And you have, there's a lot of transactions that happen between the general fund and the food service fund that get settled up at year end. So a lot of that cash may be due to the general fund, but that gets settled up after year end, after salaries. So a lot of the payroll activity and a lot of the subsidies run through the general fund, and there's some timing differences that need to be settled up at year end. And come down a little bit. And there's that deficit that we're looking at there. So it's going to kind of go up and down. It's all being dictated by the non-cash entries that we have to make to the food service fund at year end to allocate the PESers liability and the deferred outflows and inflows. So the next page of the audit report I picked to put in here. I thought this would be a good one to put here. I mean, the footnotes to the financial statements, they're really long. There's a lot of information related to
Sorry,
what we
can you just tell us which page you're on?
Oh, yeah, I'm sorry.
It's a little tricky to flip through all 91 pages.
It's on
Each
page
time you
number-
go to a new one.
Page number 50. I just didn't want them jumping around when we were, yeah. Right there. So the footnotes to the financial statements, I mean, they're lengthy and they're in excess of 20 pages. There's a lot of information in there about significant accounting policies, capital assets, also about the PESers liability for pension, for OPEB, your single employer plan pension. But I just kind of picked out this one footnote in relation to what the overall general obligation debt of the district is. These are monies that have been either, number one, monies that were borrowed for capital projects. In some cases here, some of these bond issuances refinanced other bond issuances, et cetera. But I just want to kind of outline, hey, here's what our general obligation bond outstanding as of June 30th, 2025 is $150 million. And about $25 million is coming off the top of it, $24 to $25 million. And then as you can see on the right-hand side, you have the final maturity date. So you have two falling off in April of 2027, September 2028. There was one that's coming off on November 15th of 2025. So what you're going to see is your debt service burden. I'm sure there's a plan here in place after this 26-27 budget year that your $10 million decrease in your total debt service budget moving forward. And just wanted to point that out in terms of future plans. I'm sure the plans and buildings and renovations, et cetera, moving forward. So, anybody have any questions about this slide?
Not a question, but I think it's important to highlight for the community that this, current debt of 150, or what's the difference between the 150 and the 168? So the bond premium discounts.
That's it. The
Can you
bond
explain
premiums.
that?
So every bond issuance, there's a bond premium or discount associated with it. So recently, there have been bond premiums in terms of the proceeds that you receive from the bonds are in excess of the actual face value of the bonds, just because of the the rates that you're receiving on the bonds. So what happens is once we take that amount and then we amortize it over the life of the bond, but that $17 million is not something that would need to be repaid by the school district. The only portion that needs to be budgeted by the school district is the $150 million.
Right. So the other thing to highlight here is that 150 is a significantly lower number than a year ago, which was significantly lower than the year before that. So and I think it's down by like 12%, 13% or something less than the year before.
Yeah, you've been knocking off $25 million for as long as I've been doing it.
Correct. And so that is, one of the single biggest budget items after salaries and benefits is all the money that goes to debt service. So what are we getting for that? What we're getting for that is a decrease in this debt. And at the current trajectory, if we don't reload any of these, we'll have this entirely discharged in like 9 years from now. Now, the problem is we're going to have to reload at least some of this.
It's inevitable.
Well, I mean,
Yeah.
look,
Yeah. There's
there's no
there's a lot of
rule that
buildings.
says you have to run a school district on debt.
Yeah.
There are school districts that run very well with zero debt. If we were really a premier school district, you know, and we were operating at maximum efficiency, we would be running at zero debt. You know, the problem is we have to have roofs and buses and all these, you know, other things. And so it's
New buildings.
it's a big challenge, right?
Yeah.
Anyway, I am proud of the fact that over the last several years of this board, we've made a very significant decrease in the debt burden. And we're going to try to continue to do that given the financial realities that we're facing.
And just one beat on that, because it's coupled with the questions I was asking earlier. When you don't have money as a district, and I know I'm preaching to the choir here, when you don't have money in capital reserves to do the capital projects, and you don't have an appropriate amount of money in the fund balance, then it forces you to take on more debt. So these things are connected. So our little bank accounts, our saving accounts have to be where they need to be for us to do work. And if they're not, then it goes to debt, where then it takes out of your general. So all these things, this is why I was asking these earlier, and to your side tangent, they're all connected. So we make wise choices and understand the pieces together. Thank you, this is really helpful.
Yeah, and the one other thing that I learned this year that I will share is it is spectacular the amount of debt that the school district could legally accumulate without breaking any laws. So we have, the 9 of us, and big, have the ability to rack up, I think it's about $750 million of debt before we would violate state law. Now, we would, you know, that's not sustainable. We sink the district in like 2 days, but technically we could do it. And, you know, Black Rock Middle School, which was $130 million, that was all done without ever putting it to the public through this type of mechanism. So, you know, I want to be very careful about racking up debt without involving the public. I do, if we're going to make those types of decisions, I want the public to be able to weigh in a substantive way. All right.
I think it's 225% of your average, most recent year
Yeah, which is
revenues.
completely nonsensical.
Yeah,
Like,
so that would be 700 plus, you know, what, yeah, it would be. So I just want to also say, since we do a lot of audits of our school, even though your fund balance may be lower than the other school districts in relation to your total budget, I would say that your debt service burden, or the amount that you have a debt service within the school district in relation to your total budget, is a lot less than other school districts. So it's kind of like it's like you know, so I just want to point that out too. I mean, in relation to the $150 million is not as much of a burden as some of the other school districts have with much lesser budgets. All right, next page, get to the end. So we talked about what kind of audit report you had. We talked about the finances of the school district, and I just wanted to talk about what type of findings or question costs that we may have. So we have 2 types of auditors' results: the financial statements and then the federal awards. Is absolutely crazy the amount of time we spend on the audit of your federal awards for such a small piece of your total overall budget, but it's still required by the federal government. Financial statements, like I spoke about before, unmodified, no material weaknesses or significant deficiencies, and internal control. The business office is staffed as such that they're able to implement the proper internal controls over the financial system of the school district, and then there was no non-compliance related to the financial statement. So not only do we look at, you know, whether the numbers are right, but there's certain compliance aspects in relation to that you need to meet, whether it be compliance aspects over managing your capital reserve, what's spent out of there, also any kind of non-compliance with your state funding that you receive as well, and there was no issues with that. And then the federal awards, didn't have any issue with this. The good thing about the federal awards is they are just hammered. There's oversight by PDE, there's oversight by the Montgomery County Intermediate Unit. So by the time we get to it, it's pretty beat up overall in terms of the compliance metrics that the district needs to implement. And I'm happy that the ESSER funding is no longer there. So in the case of the school district, your major programs are those considered over $750,000 and $1 million moving forward. And the only major programs that the district has historically had before the ESSER funding was IDEA and the child nutrition program. So now we're going to be able to get into a normal rotation. In this case, this year, we audited the child nutrition program, and then we could audit IDEA, and just kind of rotate those. I don't see any of your other title programs exceeding that $1 million threshold in the future. This is the last year for the 750, so threshold, they kind of increased it. So no issues, no concerns, you know, in terms of, I think we hit on everything that that I see that you guys are more than aware of. So.
Just one quick, so probably should ask this in the beginning, but you mentioned, you know, next year you're going to take a little closer look at this section than you did this year. Like, is that typical? Like, are there, if in a long-standing relationship with a district like ours, I mean, there's $360 million going in and out. You're not looking at every single receipt and every single dollar. Are there areas that you focus on more in given years than others? And could you explain a little bit more, I guess, about what is it exactly that you guys do with the receipts and the balances to arrive at this report?
Well, the good news, especially with school districts, is a little bit different than municipalities. We're able to employ a very effective audit approach in terms of, especially in relation to revenues, because of the fact that all the revenues come from some type of third-party source or like a tax collector, the recorder of deeds. So what we do is actually we send out confirmations to all of your tax collectors, and we make sure that, number one, that the district has internal controls over monitoring those tax collections, whether it be your independent tax collector or, you know, whether it be the recorder of deeds or any delinquent real estate taxes that are received. So we're actually getting third-party confirmation of almost all your revenues, because on top of that, the state and federal sources come from PDE, and PDE sends us a confirmation and says, hey, when you're doing your audit, this is the amount that we want to see in the audited financial statements. And on top of that, when Vic does the annual financial report, if he goes to submit the annual financial report and your basic education funding, I'm serious, it's off $1. They're like, we're not going to accept your report because it's off $1. So not only us, you know, confirming or matching up what the state tells us they should have received and what the tax collectors received, you know, the state's on top of it as well to make sure that those numbers can't be different than what they anticipated or they're appropriated during the state budget process. Now on the expenditure side, like you said, we can't look at every disbursement, we can't look at everything, so we have to look at your internal controls, we take a risk-based approach. We do look at more in relation to the capital projects and capital reserve because they have a lower threshold, but we really hit the salaries and the benefits pretty hard, look at them analytically. We pick a certain element or a certain amount of payroll transactions, we recalculate them, make sure they're in accordance with the collective bargaining agreement. Now we pick a sample of cash disbursements, make sure they go through the proper internal control process, et cetera. But we can't look at everything like you said, but we could look at those areas that give us the most coverage, whether it be through salaries and benefits, tuition, et cetera. So I don't know if that answered your question, but the revenue is highly effective because, I mean, and then we sample everything else. You know, whether it be tuition that you charge other school districts, et cetera.
Because we have all these cost objects, you know, there's several hundred of them that we're
Yeah.
going to go through, all these different, you know, transportation, special education, gas for the bus, you know, all these different things. And so you're saying you will sample a representative few
Correct.
receipts from every one of those cost objects, or?
Yeah, more than just a couple, you know, dozens from each one.
From
whatever,
each
like
cost
yeah,
object.
yeah, correct. And most of it's salaries and benefits. So
Right.
on the benefit side, most of it's analytics. You know, we'll take your salaries, we'll do that control test, make sure everybody's paid properly, then we'll reconcile them all back to your tax returns. And then also we'll take the benefits like health insurance, we'll look at them analytically to make sure that, you know, whoever has the highest salaries is, you know, everything's proportionate in relation to what's being charged of health benefits, social security, stuff like that.
You also take a look at the student services agreements, the money that's sent to out-of-district schools, that tuition lines up.
We
Look at
do
all
look-
these consultants, like there's a sampling of all this is what I'm just trying to verify.
But less so on that because that's not as big a dollar item as some of the other stuff is as well.
It's still
Yeah.
several $1 million.
Yeah,
so-
it's separate, yeah, in relation to $300 million, but yeah, everything is in relation to its total proportion of the total $350 million, if we look at it. And that's how the sampling forms are set up.
this call mentioned the sample, he'll select the sample, he'll ask for the documentation, they'll go through the invoices, the check, they'll get everything. Same with some of the personnel, they'll go through the actual records and make sure, we give them the collective bargaining agreements, they go through and make sure teachers are in the same cell, you know, so they go through all that in the sample representation.
I just want to, like, this is normal. I just wanted to say that out loud. Like, this is kind of like this moment in time looking at our budget in a, not just in a, you know, a horizon view, but a vertical view, and saying a sampling of budgets. This is exactly what audits are supposed to do, just for the public. Like, this is why we have audits, because it is an outside counsel that says, let me look, let me see where the things are matching up. Do you have any concerns or controls? Now, one of the things through our audit process that I'm used to is that question to the board, like to a board member for a nonprofit and to the staff, is there anything that worries you? Is there any areas of concern? Was there any areas of concern that has come up internally with the staff that says, like, this is an area of weakness in our process that we need to flesh out a little bit more? Not saying that there's a problem, but just saying this is an area you could shore this up a little.
Not that I could think off the top of my head. I think everything, you know, anything that raised a concern were those things we just talked about, you know, in terms of the actual results and how they reflect within the financial statements, like we talked about, whether it be the fund balance levels, et cetera. So I think,
Perfect.
but you have the luxury of having a business office that's able to, you know, I know people come and go and everything like that, and there may be a period of time where you don't have an accounts payable clerk or something like that, but for all intents and purposes, there is adequate staff and adequate controls to ensure that, you know, there's not one person doing everything.
Great, great, perfect. And just one comment real quick, and then I have no more questions. One, Shayna's online, I just wanted to say that for the public record. And two, we will make sure that this PDF that used as a presentation is online, so when people are viewing it, it lines up. And that the PDF that is the longer 91 pages, we will reformat, because some of the pages are vertical and some are horizontal and they get cut off. So I just wanted to say that for housekeeping, we're on it, we saw it, nobody has to bring it up, and I'm done questioning since
If I can just add, it'll be 30 days that you can actually view everything that was said. Actually, it'll be longer than 30 days. It'll be, finance committee's meetings are kept with the board ones. So it's, I just want to, it's not a 30-day.
Great. Anna, Juanita, any other questions? All right. Public questions, please.
Hello, Tanya Schreiber, Penguin, and I promise, guys, I know this is my favorite subject, but I'm going to try to keep it super short. First off, I just want to say I really do appreciate the new approach. I'll give my soapbox topic that everyone on the board here inherited a situation where I think the obligations were $770 million when they were working on BlackRock. And so the idea of using debt to build the school of the future, and it was a challenging situation to basically live on credit cards. And I appreciate that this is a far more responsible approach for the long-term good of the community. With that said, I want to take advantage of this gentleman right here. And on page 52, there's a chart about the pensions, which is one of the most significant expenses we have and obligations we have. And there's a chart that describes how our pension obligations increase based on the date of hire. And I thought it might be useful to get kind of a tutorial, a 1-minute tutorial on how that plays into the budget.
I'm going to rely on Victor on this a little bit. So PSERS has evolved. PSERS has evolved. PSERS has been around, as you can see, prior to 1983. And you're going to see in the financial statements there's a pretty large liability that's associated with the school district. Not that it's due and payable by the school district. It's, you know, in excess of $300 million. I don't know the number off the top of my head. But to be able to manage that liability, PSERS has change the benefits being provided by PEASers over years. People are grandfathered into the system. So just recently, they've made changes to the PEASer system to ensure that, future members they're not going to get the same type of benefits that members had gotten in prior to 1983. So what this table is kind of showing you is, if you got into PEASers as of before or after this date, these are the benefits that you're getting. This is what you need to contribute to the system, et cetera. So that defined contribution rate, as you're going to see, back in 2019, they made huge changes to PEASers to be able to manage the liability. So not only is the PEASers program a defined benefit program, it also incorporates a piece of a defined contribution program as well to help manage the liability moving forward. I think unfortunately, any kind of benefits that you're going to see from the change from a defined benefit to kind of more of a hybrid between a defined benefit, we're all going to be long gone by that time. But they're trying to manage it into the future to make sure that this program stays solvent moving into the future. So this right here, I don't know how much of an impact it's seen on current budgets. Vic could be able to tell you, but it's going to take time as the old people cycle out and the newer people cycle in and come in on that hybrid PEASers program versus what was being provided to employees prior to 2019.
I think what Carl's saying, the budget impact would be, in this year, I think it was 33.9% that we pay in as the employer. We get half of that back from the state. Is hopefully as the hybrid model comes in, that employer contribution will decrease over time. That's the benefit to the district.
I think it's just gonna take a while. But the good news is, when I started in this, and as Vic probably did a long time, back in the early 2000s, there were years where you didn't have to pay anything. You didn't have to pay 2%, 4%, and then 2007, 2008 happened, and everything went up very precipitously to where we are now, to 35%, and it's kind of, as of right now, holding steady in terms of that. So, I mean, it's gone up a lot especially from that 2007, 2008, but there were periods of time, I remember years where it was 0, 2, 3%. So, it was a challenge for a very long period of time. The school district committed fund balance, that's that committed fund balance, to make sure that any kind of increases in the PEASers rate kind of got smoothed in by using some of that committed fund balance. Now that it's stabilized at the 35%, does the board look at that and say, hey, do we need all this right now? Do we need to, allocate it? So it's just, managing that fund balance that you do have, and whether it's better used as a unassigned, committed, et cetera, or what other challenges the district may have financially moving forward.
So there was a point where the fund became underfunded and they asked for far more contributions, and and it's been decreasing.
Very minimally decreasing. But the great financial crisis in 2007, 2008 started the whole increase in the PEASers rate. Like I said before that, I don't remember many years more than a couple percentage points. So it's been a challenge.
But then on the right-hand column, it says that based on the year of hire, that the rates are actually going to go up for anyone hired after 2019.
That is correct. Yeah, that is correct.
Or in 2021, sorry.
Correct. So on the right-hand side, the total contribution rate. So those first couple columns with, not prior or after to. So if you were, hired on or before those dates, you only had to pay 6.25, 7.5, 6.5. Now with the implementation of new provisions first in 2011 and then in 2019, your rate's going to depend on, what plan. There's certain plans you could select now, whereas before there was only one plan. You correct me if I'm wrong, Vic. Now, with the new defined contribution rate plan, you could make a choice of how much you actually want to contribute, whereas before it was a set amount.
Yeah, so what this is in this chart here is the member contribution. So employees out of their paycheck is what is coming out. So you can see years ago it was 5.25, and now they have shifted some of that liability responsibility to the employee. That's basically what this chart is showing.
So if you look at the top, it's the member contribution rate, not the actual
so
district.
right, so it's 5.25 going down to the bottom. It gets as high as 10, 11%. 9, so you can see they're shifting more of the contribution, more is coming out of the employee's, salary towards the plan.
Again, this is nothing the district has any control over. This is
No.
state said. So Tanya, I
Yeah.
do want to be respectful if we're coming up on the hour.
No
We're trying to
problem.
limit comments to 5 minutes. Is there anything crucial related to this agenda?
Yes.
Okay, make it
So-
brief, please.
Yes, thank you. So I wanted to ask about, you mentioned internal controls. You said that you primarily focus your audit, food service, salary, benefits. Can you describe for us the internal controls that you, that are in place for the other items?
Besides food service and benefits? Or
Yes,
for-
so the broader list of like when, the Amazon cards and everything else. So what's the internal controls that you viewed?
So the internal controls, so if we pick, say, say we take at Amazon, say in a random sample, we pick an Amazon invoice, so we make sure that, it comes in, it's being reviewed and approved by Vic and his staff, and then once it gets reviewed and approved, it could be put through for processing, then it's being provided to the board for approval on a monthly basis. So first and foremost, before it gets to the business office, there's a certain level of approval at the building level, whether it be with the principal, supervisor, et cetera, or operation and maintenance. And then it comes to a second level being the business office, and then third being for board approval. Is that correct to put it? Yep.
I just want to say, if anyone is zooming in and has a question, please make sure you enter it through the chat, and we'll give you a chance to ask those too. I don't think we have any yet. Is that right?
No, we do not.
Okay.
And then this might be really inside baseball, but can you?
Last thing, Tanya, because 5
I
minutes.
know,
This is it.
I'm sorry, it's mine. Well, then I guess if this was completed in June, why is it, in general, does it usually get presented 7 months after the end of the year? Or why is the public only, like, seeing this when there's only over half of the years behind us?
So the year end is on June 30th, 2025. There's a certain element of invoices and receipts that come in July and August of each year. At that point, those preliminary results are provided to the business office, to the board, to say, hey, here's where we think we're going to end up. They talk about their commitments, their restricted amounts, et cetera. And then there's a report that's filed with the state, the annual financial report that's completed. And then at the completion of the annual financial report is put into the audit presentation and provided to the public and to the board for their review and for the board approval.
What day was it, is it generally submitted to the state? Like
It
August?
is due October 31st, right?
Okay.
By the end of November.
November, yes.
Okay, thank you so much.
And that is standard timeline across audits? Because I was going to say, you can also have an extension to submit to the state if you need it as well.
Correct, but the school district didn't
We
need
did
an
not need that
extension.
extension. It takes, what, 2 months on average to close the books out?
Mostly 3 months. I mean, we get,
3 months.
transactions for the prior year through like September. So as Carl mentioned, we're the office, we're compiling everything typically like in October-ish. Sometime October is when they'll come out and do their audit, and then we're going back and forth with different information.
Last year, we had this meeting in December. We tried to pull it off with the scheduling of the breaks, just couldn't quite do it. So this is as soon as we can do it.
Yeah, and this is standard across the board.
Yeah.
All right.
I just, again, point out normalcy.
All right, Ms. LePere, any questions, comments from Zoom audience? Nothing still?
No, we do not.
Okay. All right, then we'll adjourn the meeting. The next meeting, actually, I should say, we do have that scheduled for, what did we say, 2/27/26. And we'll post that. At that meeting, we'll go through all the revenue, which basically comes from 3 places: the state, the federal government, and the vast majority from your property tax. So we'll go through that, and look forward to seeing everyone next month. Take care.